Good evening, goons. Welcome to an episode of Jack of All Trades. I'm obviously here by myself, though with Sam, our producer, on the other end. I want to apologize for our inconsistent schedule lately because me and Kaylin are just over our heads busy. She, even Sam too. He got a new job, so we're gonna try and make up for it. But for now, I just want to kind of do a little rant slash episode on inflation because it's been a huge topic lately, and I've been like pretty vocal about it on my Instagram, but I feel like it's something important, so we should put it on video for you. And Sam, are they able to see my screen right now?
Yeah, your screen is up now.
All right, perfect. Thank you. So I'm going to start with this photo. So this is M1 versus M1 velocity versus M2 money printing. So for those that don't understand it, really quite simply, M2 is money supply. Um, yeah, M1 and M2 are basically the same thing, except M2 can constitutes more than M1. So you're looking at M1 is basically like money, all the bills that exist in the world, plus the credit from mortgages, checks. Um, it's a measure of how liquid and accessible your money is. And then you get into things that are like locked in debts, like bonds. Like if you own 10-year bonds, that's considered M2. So it's less liquid than M1. Anyway, it's a measure of how much money supply is in the market. So what we're looking at here, the blue line is velocity, which is a number which is a measurement that nobody talks about. Well, nobody except for the really sharp economists, right? So the green line is money. That's why I made it green. So clearly in 2020, the money supply went up by 20. We're almost approaching 30% now. The entire money supply that's in the market, in the U.S. market, is increased by 30%. But in the exact same time, velocity just cratered, right? So what does that mean? What does velocity measure? Velocity is a measurement at which the speed of money exchanges hands, right? So if I go buy something at the store pays their bills, whoever is their creditor, they buy something with that money. That's a cycle, right? So velocity measures how fast these cycles are. What happened? Well, COVID happened, right? So the exchange of money cratered. The problem is it's never recovered. It's actually started cratering before 2020. It started in 2018 very slowly, and it cratered. So think about what this means. It's an inverse relationship, right? If there's more money in the market, but less spending happening, then what the fuck? How could there be inflation, right? Inflation is defined by a set amount of money, more money going after the same amount of goods, right? Well, clearly no one's spending their money, right? So how can good prices be increasing, right? Well, if you look at some other statistics, okay, so here's one. So this has been my argument so far, right? So M2 money stock, that's the yellow line. S&P 500, those are the top 500 companies in the U.S. stock market. It's been on a steady climb. Look how closely aligned the relationship is between money supply and the growth in the S&P 500. It's like every time the money supply increases, or as the money supply increases, the S&P 500 increases in value. It's almost like hand to hand. This lasts since COVID, right? So my argument is this: how can there be inflation right now being caused by money when that money was absorbed by the S&P 500, by art, by housing, right? There's an article I pulled up on Forbes right here. Yeah, we have increases of 22% year over year in the US housing prices, right? In Canada, it's probably something like 30% from, Vancouver and Toronto, the major cities. And so it's like the math is very clear. If the money supply increased by 30% and the S&P 500 increased, well, by 40 or 50% by now, and housing increased by 20%, it's almost like that money got absorbed, right? So if the money got absorbed by real assets, which is homes, stocks, art, collectibles, NFTs, what have you, right? How is it possible goods prices are going up? This is where I take issue with the media and almost anybody that should know better, blaming inflation to the money printing because it's completely dishonest. What is actually happening, and since I've been very vocal about this, I've had people in the supply chain message me and confirm exactly what I said. They're like, the money printing is not the reason that the prices are gone up. It's just literally price gouging. Everything from raw material suppliers all the way to the transport to manufacturing, the distributors, all throughout the supply chain. Everybody's trying to grab a piece. And it's so easy to justify a higher price right now because you say, well, because inflation, right? I have some stats about that too. Let me pull that up. This is just like the clearest sign. Like money supply goes hand in hand with the stock market. So I don't understand why people. What is this? A producer index, semiconductors. Oh yeah. So there's a chip shortage, right? There's a chip shortage. So that would imply that there's an increase in the prices of chips because there's not enough supply. Well, why is it that the price for chips right now is the same price it was at the beginning of the pandemic? And in fact, it dropped, it cratered. So even though there's a shortage of chips, why is it that the producers' prices are just recovering now? Why are people paying a premium for chips, for video cards, or graphic cards when it's just recovered to early pandemic levels, right? And you could argue it's the same. It was the same level as 2019, right? How are consumers being made to pay extra when this is 2019 prices for producers from their end, right? This is fucking bullshit. Everybody's price gouging. They're taking their piece and they're blaming inflation. It's fucking, it burns me. Look at this: iron ore, lumber. These are like just raw materials, right? Especially building supplies. Housing is a huge market. Housing controls a huge part, commands a huge part of the economy, right? Well, yeah, we know lumber kind of went up, spiked over earlier in the year. Iron ore did about the same time, but now they both plummeted, right? Let's get this out of the way. I don't know how to get this thing out of the way. Here we go. So lumber prices is now back to levels of mid 2020, which is just higher than July 2018. So like, is there really a premium being paid for lumber? It's a very small premium, right? Same thing with iron ore. Iron ore is back to what Q2 2019 levels, right? If raw material prices are maybe 10% premium, 15% premium, why is everything so freaking expensive? I had one distributor or a manufacturer tell me that creatine prices are up 250%. There's no fucking way inflation causes a 250% increase. That's a bidding war. That's just whoever's being the supplier is just, maybe they might not have enough supply, or they just want to charge a little bit extra and just call it inflation. And who's going to argue with them, right? I mean, if I'm a manufacturer, I don't really know the raw material business. If the guy says it's up 60%, what am I to say, right? Oh, my employees, they want more money. Oh, it costs me more to ship things around the world. I'm sorry. And it ends up being about 60% increase. Who am I to argue, right? It's just completely dishonest. Now, the
And
danger
because
of
of all
this,
this, do you expect prices to return to normal, or do you think they'll continue to go up?
perfect timing. I was just going to go into that. So my guess is that the premium market, the market that pays a premium for goods, luxury goods, cars, jewelry, what have you, I don't think their prices will ever come down. Once those industries are sharp, once they know a person is willing to pay X dollars for something, it's very hard to convince them to lower that price, unfortunately. However, for the regular consumer, for the rest of us, I think prices are going to come back down. All the high volume, low margin people, see another part of this is how much they ordered during the or just after the shutdown, right? Once we started opening up, a lot of the shelves were bare, a lot of the inventories were bare, a lot of the warehouses were bare, right? And the demand was obviously high. People had extra cash to spend. The retailers are going, holy shit, they maybe might be a spending spree, right? So the theory goes that they over ordered supplies, they over ordered inventory, and they're going to have an excess of inventory soon. And this is actually, I showed this number the other day to you guys. I think I don't remember if I showed it on my Instagram, but um, Black Friday sales decline. Yeah. So Adobe does these surveys every year, and for the first year ever since they've been doing surveys, for any holiday, sales decreased year over year. Black Friday spending falls to 8.9 billion. Excuse me. And it was either matched or below 2020. So 2020 this year, we were all locked down and not spending money. This year's spending, we're not locked down, and supposedly we have extra money, and the spending was even less. Think about that, right? Less spending, more inventory necessarily means lower prices. So I think next year is going to be quite interesting in that some industries are going to um, have maintained high prices, and luxury industries, and other industries, the ones that matter, I think, to us regular people, where it's high volume, low margin, those industries are going to, I hope they get fucked right back, because If you're price gouging right now to get your piece because oh poor you, you got the shutdown cost you some money. Well, it cost all of us. So fuck you if you want to raise prices just to get your piece back because next year you're gonna have a lot of inventory. Nobody wants that shit. So I hope you put everything on sale and just survive, fuckers. Like you can tell I'm pretty pretty upset about this thing. Like, and you know what? The final here's the nail in the coffin for me. Robin Books is a guy I follow on Twitter. If you're interested at all in economics, follow this guy. Excuse me. He used to be an FX analyst for Goldman, and he's currently working for the IMF as an economist. And he puts up these updates like once a month or so. And it's a weird chart but basically these all represent countries. So you got U.S., Brazil, Korea, Taiwan. The semi manufacturers and whatnot. So what this line indicates break even price or the how do I put this the correct amount of output prices based on input prices. So what output and input means is that input prices is the prices that a manufacturer pays for their raw goods. Output price is the price they charge for those goods that they manufactured with those raw goods. This red line represents where fair value is. So a lot of these countries, Japan, Brazil, they're like just skidding just above this number. That's fine. You want to make a little bit extra, that's cool. But look at where the US is. Look at where the US is. They are charging significantly more in terms of how much they paid for the raw goods versus how much they're charging for the finished product of those raw goods. Right? And this was like what, March? So now we're in September. Oh, look at how many of these fuck-faced countries, Great Britain, everybody, Italy, everybody's jumping, fucking Germany, everybody's, even Canada, look at this. Everybody's jumping in on the party, charging significantly more than what it cost them to produce the goods. There's nobody charging at or below value. Except for these poor fucks, Philippines, like India, like this is unfortunate. China, Japan, Korea, like the Asian countries seems to be getting fucked. But look at this: all the Western countries who keep pushing this bullshit COVID narrative, who won't let this fucking thing die, who keeps calling for inflation, who keeps blaming the central banks. Look at the fucking manufacturers in these countries charging significantly more than what it cost them in terms of raw goods. It's such a funny thing when a lie just kind of aligns with a certain industry or a certain group of people, and you just see them just lose their humanity. This fucking burns me, man.
How can anybody use this information to take it and put it into the stock market?
Aha! I would avoid any commerce, any retailers right now. Oh shit! I should have saved it. There was a report from one of the big box retailers, I think just 2 weeks ago, saying that their inventories are a little bit higher than they expected to be, and this was before Black Friday. And if Black Friday sales ended up being less than expected, I'm gonna guess Christmas, what's the Boxing Day, those sales are gonna be huge disappointments, and going into next year, it's gonna be even worse. And I think I just thought of this, but this whole narrative about inflation, I think it's spooked consumers, right? To the point where it's had a negative effect on the people that try to take advantage, right? If you're trying to scare people into saying, well, not trying to scare, they're trying to say like, our prices are higher because of inflation. Well, this is called the Cobra effect, right? You say one thing expecting for one result, and then there ends up being an unintended consequence. And the unintended consequence of saying there's inflation is, guess what? People don't want to spend money anymore. They're like, fuck, I want to save my money then. Shit's expensive, right? Maybe I'll spend it on shit that matters. I won't spend it on shit that doesn't matter, right? And so like, I think especially the Q1, Q2 of next year, the big box retailers are going to suffer quite a bit. Because can you imagine their situation they're in now? It's like you now have workers demanding more money, your rents are up, you have extra inventory that you paid a premium for, and you're trying to sell it for a premium, but no one's buying. That should be very, very interesting. Yeah, that should be quite interesting. And these are the low end people, the low margin people. We're talking about the dollar shops, the Walmarts, maybe even Amazon's gonna. Oh, that would be interesting. I want to see the charts because I would love to see if Amazon is going to take a bit of a nosedive for the first time ever. Q2, actually the first half of next year, 1H of next year. That would be very interesting. Stay away from retails. Um, actually, but what I would keep an eye on is services, because what I did, a lot of the reading that I've done is showing that while good sales has not picked up, the demand for services is huge. Because one thing that you can't get during the pandemic, you can get goods, right? You can order online. What you can't get during the pandemic is services, right? Whether that's, experience holiday type services or just a fucking haircut, a lot of stuff that people haven't had for a while and they'd love to spend some money doing that. So I think those areas are about to blow up. Yeah. Let's take a swig.
Yeah, I think that's already happening because one of my friends, he's getting his house renovated, and he was telling me to gut his entire house. It's going to cost him 11 to 12 grand just to get everything taken down.
Yeah, not even anything replaced, right? Just put down.
Exactly.
Yeah. Yeah, construction's pretty interesting. There's a guy in my building. He's a foreman for sort of medium-sized construction company. I was ran into him in the elevator the other day, and he's like saying, he's like saying he was bidding for a job, and he didn't get it because based on material costs, if he bid any lower, he would have been losing money, right? And he said his competitor won, but is probably going to end up losing money because from the date that they submitted the bids to the date that the price was agreed upon to the date that I talked to my neighbor, material costs went up even higher. So whoever the competitor is, they're gonna have to honor that contract and just suck it up and do the job for a loss. And that can't be, a terribly unique story. You know what I mean? So I think I think 2020 is gonna be an economic storm, but that doesn't necessarily imply like doom and gloom recession. But it certainly won't be zoom zoom that I say on IG. Like I certainly don't expect zoom zoom to happen. I think it's going to be chop, which means it's going to be actually it's basically what we've experienced for the last, I'm going to say 4 to 5 weeks in the market is probably what we should expect for next year. A little bit more downside, but mostly sideways movement and chop. And for those people who wanted to trade, chop is the worst thing in the world. It's the worst condition in the world to be in to the markets, because if you lack discipline, if you don't have, like Kalen, like if you don't have a really strict set of rules and guidelines and strategies you use, you cannot win trading chop because you're going to make the wrong decision almost every time. As for investors, put your money into the companies that you believe in 3 to 5 to 10 years out, and don't look at it and just leave it, right? If you want to take advantage, put some money aside, buy some dips, cool. But don't try to react to the market is basically what I'm saying, is because that's gonna destroy you. That's gonna destroy you. And the money's gonna go to guys like me who know either not to play the chop or how to buy a dip, right? Actually, let me just pull up my Instagram. That's better if I just say it, but
What about for people who need money now? Like, for example, my friend who's getting his house gutted, he needs to sell off some of his equities because he just needs the money to pay for the house and everything. But then the thing is, he has no choice but to end up selling soon. When would be a good time for him to let it go? Is it now or is it later? If someone was in that situation.
yeah, I wouldn't mind selling now, especially if the money's going to go to another hard asset like a home. I mean, the market's like, let me just like take a look. Let's S&P 500 is probably at or near all time high. We are. Oh, so this is the monthly. Let's take a look daily. So we are literally 1%, 2% from the top, from the highest we've ever been. It's 4,600. 4,600 was like a ridiculous dream just years ago. Like this was the previous top. This is September of last year. We're still 3 full percentage points higher than where we end September of last year. And people think like the stock market's crashing. Like no, like now is a fantastic time to sell. I mean, if the market leaves you here, is it really a bad thing to sell near all-time highs and then just discover later that it kept on going? especially when that money is going into a home, which is going to accrue you some value, and you live it in every day, so you can definitely enjoy the difference. I mean, it's just, there's a lot of things that people should consider, right? Not just opportunity cost. People can lose themselves thinking about opportunity cost in the stock market. There's always like, oh, there's a better play here, or oh, I should have kept this or sold that or whatever. It's like you're gonna drive yourself nuts worrying about opportunity costs in the market. What people should be viewing, how I view the market is like, I have a pool of money, and it's not my money, but I'm the portfolio manager of this money, and so it's my job to decide where best to allocate this money, right? Where the best returns would be over time. And so, like, if you look at it that way, don't look at it something as something that you can spend or you can get back and then you could then use for something like a home, or just whatever vacations. You just look at it literally in terms of numbers and how to allocate it and how do I make these numbers bigger, right? And so, like, you can divide things in. There should have been another episode. I was going to talk about portfolio theory, but I'll touch on it now. Like, you should look at your entire portfolio in terms of risk. And so, like, there's a lot of times I get messages that they're like, "Oh, I'm in crypto. I'm in, they have this altcoin, they have that altcoin, they have this altcoin, they have that altcoin." They're like, "I'm diversified." Like, no, you're not diversified. You basically have the same risk profile. They're altcoins. That's it, right? Saying that you have Bitcoin and altcoins doesn't make much difference either from a portfolio standpoint. You're basically still in crypto. That's one market. And when that one market crashes, I don't care what coin you have, you're fucked, right? Portfolio theory is that you divide it based on complete different markets. You have assets like a home, you have maybe collectibles, you have art, you have a car, you have stocks, you have bonds, you have gold, there's so many different areas where you can spread the money around, right? And so you look at the list of things where you can put the money around, and you say, well, what do I want to own? And then you pick out maybe two or three or four things, and you say, okay, I'm going to put my money into these things. And then how do you divide it, right? Well, the way I look at it is that I look at it in terms, again, in risk, right? Equities to me is less risky than crypto, right? So how I want to do my portfolios, I want to put maybe the majority of my funds into equities, and the more high risk stuff, which is crypto, I want to put a lesser amount of it into it, right? So here's a great argument for portfolio allocation um for like somebody like my mom. Like I kind of put her into crypto because by buying the Bitcoin ETF, but how I did it was, it's I think 5% of her portfolio, right? Um, but let me use a different number. Let's say your parents are risk averse, put 2% of their portfolio into crypto. What does that mean? Well, if you have $1,000 portfolio and you put $20 into crypto, you lose that $20. It's not the end of the world, right? But you calculate the upside. Crypto has a tendency to move 10x, right, all the time. And so if you have 2% of your, or $20 of your portfolio into crypto and it does a 10x, that's $200. So your $20 investment just became $220 in $1,000 portfolio. That's a 20% gain off a 2% allocation, right? That's how you look at a portfolio, right? You look at stuff that has outsized, the potential for outsized gains, and then you balance that with stuff that's more safe, right? Like we should, I'm sorry, but we shit on Dogecoin, we shit on AMC all the time because people go all in with it, right? If somebody came to me and says, "Yeah, I put a 5% allocation of my portfolio into AMC," I'd be like, "Fucking smart, right? AMC does a 50%, does a 100% move. You just did quite good return on your portfolio off a very low risk allocation, right? If AMC went to zero, and no company goes to zero, by the way, but if AMC did go to zero, what do you lose? 5% of your portfolio? You can make that back up, right? Just putting your money in the market in the S&P 500 usually yields you anywhere between 4 to 7%. And so, like, if you put 5% of your portfolio into something that's like high risk, you're gonna gain that back on balance a following year. So it's really not that risky, right? And so that's why I say look at your portfolio in terms of risk, right? My personally, like, and so like between once you divide it between, like, let's say crypto and, like, if you're my parents' age, you probably have bonds, equities, and then crypto, maybe, right? So let's say you look at your your equities pile, then you then divide that by risk, right? You say, what are my staples, right? So I've been managing my mom's portfolio for a year now, and she's up 43% for the year. And this is a portfolio that has done less than that in 10 years, right? So how did I do that? Well, we put first thing I took it over and I sold her freaking farmer stocks. High risk, really low return. She's got a big chunk of money there. She has the chunk of money there because she works in farmers. So she's like, that's all I know. I sold that money right away. I put it into Tesla. And she's always opposed to Tesla, not because of the company, but because of how expensive the stock is. Well, this was back when Tesla was about this in the $600 range. It wasn't expensive, relatively speaking. So I put the money in there. So her core holdings were Tesla and Apple. And the reason that those are her core holdings is because these are companies I believe in 3, 5, 10 years out are going to be very, very strong, right? Especially Tesla. It's a dominant player in a nascent industry, which means the room for growth is astronomical, right? And so then I decided to put her in some more high risk stocks, right? So I put her in XPeng, right? Still a nascent industry, which I love, but it's a little bit more high risk because they're younger, they're more less quality, less funding. But if you look at XPeng's chart, this thing can run, right? So I think I put her in about 4% into that stock, and then of course I bought her some Bitcoin ETFs, right? So within just the pool of equities, you can divide that by risk as well, and so yeah, so that's portfolio theory, and so like taking it back to my outlook for inflation in the economy, it's like my view is this: knowing what I know, I'm still not going to change my portfolio design at all. I still have my Teslas. I still have like so inflation is supposed to be bad for growth stocks, right? When you make money hard to borrow, when interest rates are high, growth stock tends to suffer because they basically rely on this continued infusion of money to keep them going because they're not really profitable. Well, I'm sorry, but Tesla's very profitable right now and they're growing. And again, nascent industry, so that's going to keep growing, right? And so like I have no fear that under any condition Tesla's going to survive. And if there is a condition in which they don't survive, everybody else is fucked even more. So that's my thesis for that. So the bulk of my portfolio is still in Tesla. And then I still have my Bitcoin ETFs because I don't believe this run is over. I still have my XPeng, I still have my Vimeo. I have like a handful. I have Nvidia, right? And so when I look at that portfolio and I look at inflation, I'm like, I don't see inflation affecting Nvidia too much, right? I don't see inflation affecting XPeng too much. They sell almost exclusively in China. What's my risk? And actually, to be honest, Bitcoin ETFs might do well under an inflation economy. So, I mean, you can totally design a portfolio. If you're clever, you can totally design a portfolio that is both safe and somewhat of an inflation hedge without having to dip your toes into the traditional shit like bonds, because bonds are supposed to be great for inflation, which I completely disagree with. So actually, let me touch on that really quick. Right? So a friend of mine messaged me recently. Right, he used to manage a fund on Wall Street, so he's like my guy for getting to know how Wall Street thinks. So we got to talking, and he gave me some insight. He's like, portfolio managers on Wall Street have a mandate to perform, meaning they're judged, quarter to quarter, year over year, whether or not the stock market is healthy. They have to allocate that money to something, and so like they have to buy bonds. If there's nothing else that could yield a better return, that they have to buy bonds, right? They have to be in the market because what he told me was interesting. He said, if the entire market is underperforming, them underperforming doesn't make them look bad. They kind of get a pass on that. What will make you look bad is if the market is performing well and you're not in the market. And so your competitor is giving their customers returns and you're not. And so that creates an interesting dynamic where there's a lot of money in the market that's literally just being forced to be in the market. That I find interesting, and I think that that's going to be an interesting thing next year because knowing that money is going to be there, have to be allocated to something, and knowing what I know about how bullshit and inflation everything is, I think the companies that will surprisingly outperform, like the growth stocks, because they're expected to underperform in an inflationary environment. I think the people selling them off right now, which we're seeing like today, this week, last week, that money is going to go back into these guys. Because can you imagine like growth stocks, technology stocks that have been sold off pretty hard? Can you imagine if they survive this thing and they keep doing well, better than bonds, better than what's it called, the um, the value stocks. If you're a portfolio manager and your more high risk competitors got their hands on Tesla, got their hands on Nvidia, Facebook, they're performing, they're overperforming, they're destroying your returns. You're going to have to adjust pretty quickly, and that adjustment could cause quite a few runs on stocks, on growth stocks, tech stocks. So, I mean, I could go on this rant for a long time about how portfolio managers think. I think all of them are the young ones are cool, but the older ones, the ones that made money in the 2001 crash, they all hate technology, and the ones who made a lot of money then like to bet on technology failing. And it's a human error thing where it's like, you'd like to return to the same pool or the same pond that gave you water to begin with, right? You like to return there. They think, well, the same thing's going to happen this time. The problem is it's not, and so they're gonna be taught a very important lesson. Actually, I'll say this real quick, right? Because I'll reference our podcast, because if people want to listen to the podcast, go backwards and listen to it the whole year, or haven't listened to the whole year. Can you name one time we made a weird call or a call that wasn't correct? I said the fucking Evergrande thing was bullshit. Going backwards, I said the Evergrande thing was bullshit. I called the bond market thing being bullshit. Oil, lumber, these were all bullshit. Semiconductors, bullshit. Like, if you observe the pattern, it's like every time they come out with a scare in financial news, the market reacts because they know it's mostly retail that's in charge, right? The market reacts, and within 2 to 3 weeks, the market is back up, actually even higher than before, right? And then within 2 to 3 weeks, maybe a 1 month news cycle, there's a new scare, whether it's Omicron or whatever, right? You can almost time it. Every time the news gets a little bit quiet, they come out with a new scare that ends up being bullshit. Market sells off. Somebody buys a dip. Somebody buys the dip, and the market recovers. If you don't know you're getting played, then you're losing money. If you're not aware that you're being played, you're being played. So, yeah, take everything you read with a grain of salt. And this is a great educational time because if you can start seeing through the bullshit, if you can start acquiring resources like I have, like Robin Brooks on Twitter, and just get a bunch of good, solid resources to inform your decisions, you're gonna come out very, very strong, either an investor or a trader. And I think going forward, I mean, hopefully you're young, but going forward, 5, 10, 20 years from now, this is going to be a life skill that could really help you, because it's really helped me. But I want to really quickly say that when I say a source, it doesn't mean CNBC. When I say source, it's not Bloomberg. Those aren't sources. Sources for me are individuals like Robin Brooks who have a track record, who have some way, some shape, or some form of getting information that I don't have. And what I do is I find people like him, but generally counter to his position or counter to his opinion, and then I follow them. And then when you've got a group of people like that, or sources like that, who may not agree with each other but have real logical opinions and formed on real data, what you end up having is a very clear picture. What you end up having is a perspective that has very few flaws, and then you use that to inform your decision making. You're going to find yourself very fortunate to be in that position, like I have. All right, sorry if I rant is a little bit long, guys, but thank you for listening. Thank you for sticking through it, and we hope to be back full force next week. All right, take care.